Happy to have you on Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwago. Coming up on the show today, South African insurers to fund vaccines for broader population. And Ghana's National Insurance Commission extends recapitalization deadline to January 2022. And Kenya's to brace up for more taxes in 2021. Let's get the show started now with intraday market numbers. And starting here in Africa, the Nigerian stock market was quiet with the index unchanged at 40,683.94. Other markets in the region were positive, with the JSE index posting the highest intraday gain of 0.64%. In Egypt, the main index rose 0.18%, while Kenya ended the first trading session in the new year negative. And markets in the Gulf region were mostly positive at intraday, except Saudi Arabia index, which was marginally lower by 0.09%. On the flip side, the Qatari index surged the most in the region by 1.43%. In the UAE, Dubai's main index rose 1.16%, while the Abu Dhabi index advanced 0.22%. And in Europe, stocks were mostly higher this morning as investors monitored the coronavirus pandemic and the imposition of further restrictions, along with a U.S. Senate runoff election in Georgia. Well, Chelsea Dulani joins us now. Hello, Chelsea. Good afternoon. Well, I'm seeing you for the first time in the new year, so Happy New Year to you, Chelsea.
Thank you. Happy New Year to you as well.
Now, Germany is expected to announce an extension of coronavirus restrictions at a meeting later today. How much longer is the country expected to remain in lockdown?
It's almost certain that we will see the lockdown extended until the end of January. The federal leaders and state leaders are just going into this meeting now, but over the past couple of days, we've seen pretty much a united front from politicians saying that they do believe an extension of the lockdown is necessary. That will mean that bars, restaurants, retail stores are all going to remain closed for this period. Now, the big questions out of today's meetings are, will the government strengthen contact restrictions? So far, people have been able to meet with another household up to 5 people, and that's been allowed under the current lockdown. They're discussing now making those rules much stricter and only allowing people to meet with one other person. The other big question for today's meeting is what the politicians are going to decide to do about the schools. So schools have been closed over the holiday break, but because of this current coronavirus situation, there is a call and there is an increasing amount of concern about the prospect of reopening schools. So whether they will allow schools and daycares to reopen is very much up in the air. It's quite controversial, but this is likely to see some changes as part of these new rules announced today.
Meanwhile, EU politicians are being criticized for the slow rollout of coronavirus vaccines across Europe. Why is the EU falling behind other countries in vaccinating?
The EU is certainly lagging other countries in terms of the number of people that have been vaccinated so far. So here in Germany, only about 250,000 people have received vaccinations. That's compared to almost 5 million people in the US and over 1 million people in the UK. So even when you account for population differences, Germany is lagging much farther behind, and the rest of the EU even further behind. One of the reasons for this is because the EU was slower to approve the Pfizer-BioNTech vaccine than the UK and the US. They only approved it in the middle of December, so we've only started to see vaccinations really kick off over the past couple of weeks. But there also is a lot of criticism of the fact that the EU basically passed over some options to buy other vaccines, particularly the Pfizer-BioNTech vaccine, which is the only one approved in the EU right now. They did pass up an opportunity to secure more doses of that, and now we are seeing fewer doses available in the EU of that vaccine. EU leaders, for their part, say that this will change as we see more vaccines approved. The Moderna vaccine, the AstraZeneca vaccine in the UK are likely to be approved in the EU at some point soon. So we will see more vaccines coming, but this does put the EU quite far behind the rest of the world in terms of getting the population vaccinated.
All right, let's look at the data front. A new data out today shows that German retail sales actually rose in 2020 despite the virus impact. What's behind the growth?
Yeah, a bit of a surprise from this new data from the German government. They're saying that they think retail sales in Germany will have risen about 4% for the whole of 2020. And that's even as we've had retail stores closed for big portions of 2020. The bulk of that growth is coming from, like we've seen all over the world, the huge boom in e-commerce. And in 2020, they expect that internet retail sales were up about 30%. So that's definitely helped to offset some of the declines we've seen in other parts of the retail landscape. So people aren't really shopping at department stores right now. They're buying things on Amazon or on other online retailers. We've also seen a bit of a jump in sales of home goods. So people are renovating their houses. People are buying more things for their homes since they're basically quarantined there now. So that's helped to drive retail sales up overall. But at the same time, this has benefited the online retailers and not so much the small and mid-sized retailers who don't have as much of a online presence. So it's overall a mixed bag for the retail sector.
You know what, Chelsea? I'm very optimistic 2021 is going to be a great year. So let's be hopeful. Enjoy the rest of the day. We're nowhere near yesterday's gain, but the FTSE 100 is holding comfortably above 6,500 and was up 0.5% in the morning. This comes amidst the fresh lockdown in England and part of Scotland. Juliana will give us more update. Hello, Juliana. Good afternoon. Well, Chancellor Rishi Sunak has announced new £4.6 billion support for businesses hit by fresh lockdowns. What are the details? What goes to who?
Good afternoon, Chimeze. Well, yes, the Chancellor of the Exchequer, Rishi Sunak, just a couple of hours ago has announced these new economic measures to support struggling businesses. And it comes just shortly after a chorus of calls from businesses across the country, basically saying that it will be impossible for them to survive. This money will be given out as grants of up to £9,000 per premises. So if you're in retail, you're in leisure, you're in hospitality, you can, each particular space, and I believe there are about 600,000 spaces in England, you will be able to receive this money. Is it enough for many businesses? No, it's just not enough. This is the third lockdown that Britain is going into. Some are saying it's the third, but of course there have been so many other restrictions. And typically, even though January is a very slow month for most sectors, they would have just been coming off the back of the best month. You know, it's called the golden quarter for a reason. And that's because during November and December, businesses can reap the benefits of the Christmas trade, but they haven't been able to do that thus far. And we are going to be in this lockdown for what it appears to be a very long time. Some suggestions of February, mid-February at the earliest, although there are others that are expecting these restrictions to be in place until the end of March. So at least there is a small sigh of relief, but for some businesses, it's just not enough.
And of course, with this latest announcement, markets, of course, are reacting. Can you bring us up to speed with market numbers at intraday?
Well, surprisingly, the FTSE at intraday is doing much better than its continental partners. The FTSE is up. The FTSE all-share is up by 0.53%. The FTSE 100 is up by 0.56%. And the FTSE 250, the domestic market, is up by almost 1%. At intraday as well, the British pound outperforming the dollar by 10%. Down on the euro, though, by 0.14% and down on the Japanese yen by 0.19%. It's worth mentioning that oil majors are what's really driving the FTSE share at intraday. Both BP and Shell are up by over 2%, and that's because of the oil market recovery at early trading.
And in corporate news, Next has reported that its Christmas profits is better than expected because of online sales. However, the chief executive warns that gains will be almost entirely offset by latest COVID restrictions. The feeling is the same across the retail market, I suppose.
Yeah, that's a correct presumption, especially because Next, as well as just a lucky one or two others, have done really well, even during the lockdown. As soon as they mentioned their trading update at early trading, their shares were up by about 8.9%. They did, however, say that overall sales in the 6 weeks to December were down 1.1%. The amount of people coming into stores was down 43%, but they did see a surge in online sales by 38%, which seemed to have cancelled out the less amount of footfall they're seeing in their stores at this time. There was a dour note, and that, of course, is to do with the lockdown. 99% of their stores are going to be closed during January. They said that's going to cost them £18 million. And they said if the lockdown lasts throughout February and March, then their sales, their profits will be down by at least £53 million.
Well, Juliana, I guess our duty is to continue to track those numbers there. Enjoy the rest of the day. And shares of Chinese telecommunications giants today after the New York Stock Exchange announced it will no longer delist the firms. Hong Kong listed shares of China Mobile sold 5.47%, while China Unicom surged 6.71%. China Telecom stock jumped 5.74%. Overall, Chinese stocks were mixed, with the Shanghai Composite down slightly while the Shenzhen Composite gained 0.542%. Hong Kong's Hang Seng Index declined 0.31%. Shares in other Asian Pacific markets were lower. Japan's Nikkei 225 declined 0.35%, while the Topix Index was 0.31% lower. South Korea's Kospi dipped 0.18%, while shares in Australia dipped, with the S&P ASX 200 down 0.24%. And U.S. stock futures held steady early morning trading after the S&P 500 suffered its first decline to start a year since 2016. Futures on the Dow Jones Industrial Average rose 45 points, while S&P 500 futures and Nasdaq 100 futures were also both slightly higher. The move in futures came after a sharp sell-off on Wall Street to kick off 2021. The S&P 500 fell 1.5%, posting its worst daily performance since October the 27th. The broad market sell-off occurred ahead of Tuesday's Georgia runoff elections, which will determine whether Republicans can hold on to control in the Senate. And in global oil market, prices edged down in early trade today before deadlock talks between major producers about potential changes in February output are set to continue later in the day, while fuel demand concerns lingered amid new COVID-19 lockdowns. Brent crude futures for March fell 0.2% to $50.97 a barrel, while U.S. West Texas Intermediate crude for February was $47.56 a barrel. Both contracts fell more than 1% on Monday after the Organization of the Petroleum Exporting Countries and its allies, a group known as OPEC Plus, failed to agree on changes to February's oil output. On the metals market, gold prices inched lower earlier today after hitting an 8-week high as the U.S. dollar halted its slide ahead of the Senate runoff elections in Georgia. Spot gold was down 0.2% to $1,938 per ounce, while U.S. gold futures shed 0.3% to $1,941. Among other precious metals, silver was little changed at $27.22 an ounce. Platinum lost 0.2% to $1,063, and palladium shed 0.5% at $2,360. We'll take a break, and domestic commodities market update is up next. And on domestic commodities update, we're turning our focus to Nigeria's cement industry. Cement is a major input for housing and civil construction, and the price of a 50 kg bag of cement has jumped by 34.6% from 2,600 naira to 3,500 naira in December 2020. Now, this price increase is happening at a time when the vacancy rate for residential property at a high of over 30%. But what will this increase mean for the real estate sector and, of course, cement producers? These and more are some of the questions Oluwaseyi Omidiora, an associate with Financial Derivatives Company, will be answering on this show. Hello, Luashe. Thank you very much for joining us. Good afternoon and Happy New Year to you. Now, with
Thank
the
you very much
recent
and Happy New Year.
Thank you. For the recent increase in the price of cement, what are the implications of this on the real estate sector and on the demand and, of course, price of granite, which is a raw material for cement manufacturing?
Now, what we are expected to see, or one of the primary considerations, we should actually note that there are a number of other factors that will affect or impact the real estate sector. For example, the recession we currently are in, that's one thing. Another thing to look at is the fact that it's the high probability that the capital budget allocation will not be fully executed. These are two things I think we should also look at. But moving now into the recent increase in the price of cement, I think one of the things we are expected to see will be a decline in new developments, new projects coming up. That's going to be one possible effect. Now, another thing we are likely to see is delays and maybe outright abandonment of ongoing projects. This is definitely not what we want to see. But the worst case scenario in all of this is a situation where contractors and builders begin to compromise on quality. This is definitely not something anybody wants to see anywhere. Now, talking about the effect of this recent increase on the price or demand of complementary goods like granite, now we expect that this recent price increase will lead to a weakened demand for a complementary good like granite.
And then the Nigerian stock market has witnessed a rally, rising by more than 45% last year. The industrial sub-index also appreciated by approximately 90% last year. Now, if the price of cement were to fall, what impact would it have on the stock prices of cement manufacturing companies like Dangote Cement, Lafarge, and Bua?
It's important to note that the recent price rally in the stock market was not driven by any fundamentals, really. Now, we see companies like Lafarge, for instance, that actually sold off their South African business in late 2019. Now, this could have also had an effect on the sub-index performance in 2020. This could have been one of the drivers for the stock of Lafarge. For Dangote Cement, we saw the recent buyback program, which they embarked upon, and this also could have had an impact on the sub-index performance and, of course, the general market. But ultimately, we actually saw that all through the year, the recent increase, the recent growth in the stock markets was not driven by any fundamentals, really. Now, if we go into the recent the price, if the price of cement drop, now what we are expected to see will be little margin contraction for these cement producers. And when that happens, it might actually shift investor sentiment. But going back again, we see that a lot more other factors are at play here in the stock market, the interest rate environment, for example, and high liquidity. Now, I believe these are more important factors and more important considerations in the stock market than the price of cement itself.
All right, let's look at the headline inflation. From November 2020 was 14.89%, but cement prices now have increased by about 35%. Why has the price of cement increased by more than double the rate of inflation? And what will happen if cement prices were to fall as the rainy season approaches?
Now, one primary thing we should actually note is the price of cement has been largely flat for a number of years now, and this recent increase is coming as a surprise because a number of raw materials like limestone, like shale, like marl, like clay are locally sourced. But then we need to look at the products or the equipment, that are imported that used in the manufacturing of cement itself. Now, a lot of these, as I said, a lot of these equipment are imported. And with the recent devaluation of the naira, this could have had an impact on the prices at which those equipment are purchased, and could have led to a subsequent increase in the price of cement. Now, another thing we should look at is in the past, there have been reasonable volatility in the price of input costs like granite. And this, of course, the cement manufacturers could have absorbed some of these cost increases. Now, what we are currently seeing is the likelihood that these manufacturers are being compensated for the absorption of these costs in the past. Now, talking about what might happen if the price of cement falls as rainy season approaches, cement makes up, if we look at the Nigeria CPI basket, cement, which I believe can be found in the miscellaneous goods section of the CPI basket, we see that it contributes just about 1.67% or 1.7% to the overall CPI basket. This is unlikely to have any real long-term effects on headline inflation.
All right, thank you very much, Oluwaseyi. We do appreciate your time. Enjoy the rest of the day. And South African medical insurance companies, business organizations, and the government are developing a program in which the private sector will help fund COVID-19 vaccines for people not covered by insurance. The head of the health work group for B4SA, a grouping of South Africa's biggest business organizations, says legislation has been amended to allow the companies to fund shots for people who don't have medical insurance, and talks are now focused on the number of those who may benefit. And Ghana's National Insurance Commission has extended the deadline for the recapitalization of insurance companies from June 2021 to January 2022. The extension of the deadline is as a result of the economic impact of the COVID-19 pandemic, which has affected all businesses around the world and in the country. And Kenya Revenue Authority says Kenyans will pay more taxes in 2021 following tax amendments signed at the end of 2020 and the expiry of tax relief measures set during the start of the pandemic. Low salary earners are to expect more deductions following changes in tax rates that removed lower tax bands, specifically eliminating 15% and 20% rates as the Revenue Authority seeks to improve revenues from salaries. That's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwagu.